There are very few places where you can get true passive income, where you can just throw your money at something and then forget about it, do something else, and keep getting checks every single year. One of the few places where you can get this type of passive income is in the stock market with dividends. And in this video, I'm going to be going over how you can replace your day job income with dividend income. What's up, everybody? I am Jaspreet Singh from theMinorityMindset.com and welcome to the Minority Mindset. First off, before we get into today's video, I just want to take a quick second and thank all of you beautiful people for helping our channel get to 700,000 YouTube subscribers. I'm not oblivious. I am very thankful for what I have and what we have built. I am very thankful for your support and all of your comments below, because it allows me to come here and make videos like this, doing things that I love, talking about money management and helping spread this minority mindset message so we can break away from the majority mindset thinking and really take our finances into our own hands. So thank you so much for your support. Thank you for all of your help getting us here, and I can't wait to see what's coming next. Now, let's get back to today's video. The stock market is a place where you and I can go and invest in companies. Like if you really like Chipotle or you really like McDonald's, you can go and invest in these companies and buy shares in these companies, and then you become one of the owners of these companies. Then, once you are one of the owners of Chipotle or McDonald's or one of these companies, if they have a big profit at the end of the year, they will distribute some of this profit to their owners as dividends. You can think of a dividend essentially as a profit sharing check. If a company has a bunch of cash in their bank account at the end of the year, there's three things they can do with this cash. They can save it, they can buy back their own stock, which makes the stock price go up, or they can give this money to their shareholders, their owners, you, the people that own their stock, as a thank you for investing in their company. Not every company pays a dividend. Like, you're not going to see a lot of tech companies and growth companies, these startups, pay dividends, because these companies are investing every extra dollar they have back into their company, because their goal is to grow as big as possible, as fast as possible. So the companies that pay dividends are typically your larger, kind of more stable companies. However, dividends, if you do them the right way, can be a great way to create a new passive income stream or even replace your current job income if you know how to do it the right way. So let's calculate how you can get enough passive income from your dividends. That way you can replace your job income. Now, before we do that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. All right, let's say you make $60,000 a year from your job. So if you want to replace your job income with dividends, you need to make $60,000 a year passively from dividends. Now, let's assume that dividends pay a 3% annual return a year. So for every dollar you invest in dividends, this company is going to pay you 3 cents in dividends. That means if you want to make $60,000 a year with this 3% return in dividends, you're going to need to invest $2 million right now to make $60,000 a year in passive income from dividends. Now, before you get angry and say, but Jaspreet, I don't have $2 million, let me go smash that thumbs down button. Well, we're not done yet. As you can see, this video has a lot of information left. If you wanted to go out and get the $60,000 a year in passive income from dividends today, and the stock is paying you 3% a year, then yeah, you're going to need $2 million in cash to buy shares of the stock. That way you can get a 3% return, which is $60,000 a year. But this isn't the only way to get this dividend money. Now, to get an idea of how much companies actually pay in dividends, let's take a look at some numbers. So AT&T pays out a dividend of 7% a year annually at the time of me recording this video. Verizon pays about 4% a year annually. Pepsi pays about 2.9% a year annually, and McDonald's pays a 2.5% dividend annually. That was just to give you an idea of what types of companies pay dividends and how big these dividends are, but you should never invest in a company solely because of the size of the dividends. I'll show you why. Let's say this hypothetical company is trading for $100 a share right now, and it is paying a $5 annual, let's write DIV, $5 annual dividend. So based off of this current share price, that means this company is paying a 5% annual yield, because for every $100 you invest, you get $5 a year in dividends. Now, let's assume that this company starts tanking. It does not do very well and it starts losing money, and the price of this stock falls from $100 a share to $50 a share. Now, if they haven't adjusted their dividend price yet, because they haven't gotten to that point in the calendar year, then what you can see happen is they're still paying this $5 dividend because they haven't adjusted this yet. And based off of the numbers, they're paying a 10% annual dividend right now, but the part that you're missing is that this company has fallen from $100 a share to $50 a share because they're having internal problems, they're losing money, and maybe they're on the verge of bankruptcy. Who knows? So you should never invest in a company just because of what dividend yield they're offering, because there's a lot more to it than that. Sometimes a company's dividend is going to look artificially high because the share price has dropped drastically. So now back to the original question, how do you replace your income? So let's say this company is trading for $100 a share and their goal is to pay out a 3% annual dividend. Well, off a $100 share price, that means they're going to have to pay $3 dividend. I'm going to do DIV, $3 per share for this dividend. So for every share you buy, you're going to get $3. Now again, if you wanted the $60,000 today, you're going to have to go in and buy $2 million worth of stock. But I'm going to assume that you don't have $2 million in your bank account to throw into this random company. The interesting thing about dividends is that they compound and they grow. Let me start by talking about how dividends can grow. When you invest in this company, if you paid attention to what I said earlier, you're not investing because of what their dividend price is. You're investing because of how strong the company is. You're investing because you believe in the strength of this company and what they're producing. Maybe they're innovating some new technology. Maybe they're creating some new guacamole that everybody wants. Who knows? They have this product that everybody wants that you think is going to grow. So let's assume you buy in at $100 a share and then 5 years go by and then this company starts to make more money. And what happens is over those 5 years, it goes from $100 a share to $200 a share. So now what has happened is you have already just doubled your wealth in the stock. You might feel pretty good here, but you have to remember, if this company is paying dividends, they might want to attract more investors who want to buy into this company because of their dividends. And if they're paying $3 a share for their dividends at a $200 stock price, that's not a 3% annual dividend, that's a 1.5% dividend. So if they want to maintain this 3% annual dividend, they're going to have to double how much money they're paying out in dividends too, which means now they're not paying $3 a share, they're paying $6 a share in dividends. But you didn't buy the stock at $200 a share, you bought in at $100 a share. So yeah, while the people that are buying it today are getting a 3% return on their money, you bought in here. So you're actually getting a 6% return on your money because you bought the stock for $100 a share and now they're paying you $6 a year in dividends per share that you own. So if this company is making really good guac and the value of their company doubles, you're going to see the stock price double as well, which means you have just doubled your investment. But if they want to keep attracting these investors who are investing for dividends, they might have to raise the dividend price. And if they want to keep it at this 3% annual yield, they're going to have to double their dividends. But we're not done yet because I want you to be a long-term investor because the investors who make the most money are the people who have the long-term mindset. And so now let's assume this company continues to make new guac and they create these new guac variations. And now 5 years later, this company doubles again. So now they're not trading for $200 a share, they're trading for $400 a share. And so for the people that bought here, yeah, they doubled their money, but you are now quadrupling your money because you bought in early. And so now let's look at the dividends. If they want to keep this 3% dividend yield because they want to keep attracting those dividend investors, what are they going to have to do? They're going to have to double this dividend price from $6 a share to $12 a share. You bought in when they were paying $3 a share in dividends. Now they're paying $12 a share in dividends. You bought in when they were paying a 3% dividend yield. Now it's going to be a 12% yield based off of the investment you put in initially. So if you bought into this company at this point and you held your stock for 10 years and the stock doubled twice and they wanted to maintain their same dividend yield, now you're making a 12% return on your money, not a 3% return on your money, which means you just 4x the amount of money you're making in dividends by doing nothing except holding the stock. And these returns really are not that unreasonable. Remember, we're talking about a 10-year span. So we're talking about a decade. It is not unreasonable to see a company double their share price twice over a span of 10 years. Is this guaranteed? No, of course not. Investing has risks. You are never guaranteed to make money when you invest. You might even lose money. Maybe this company will go bankrupt. But you are never going to make any money unless you take a risk. And this is not an unreasonable, never heard of returns. These type of returns do happen. But you have to remember, this is not something that happens over 6 months or a year. We're talking about a decade. Now, if we go back to the original example where your goal is to make $60,000 a year in dividends, originally it took you $2 million over here. If you bought $2 million worth, it would take you that much money in order to get a 3% return, which would give you $60,000 a year. Now, if the company you invest in follows this type of growth where they can double twice and the dividend value doubles twice over the course of you holding it, now you don't need to invest $2 million to get this $60,000 a year. You need to invest $500,000, $500,000, because now if you invest $500,000 at this price and the dividends go up to 12%, now this 12% return on $500,000 worth of invested cash is going to give you $60,000 a year. And now you might be thinking, Jaspreet, I don't have $2 million to invest to get the $60,000 a year, and I also don't have $500,000 sitting in my bank account to invest to get the $60,000 a year. Well, we're not done yet. I'm going to show you how you can scale up your investments slowly. That way you can get this goal of building this income stream from dividends. That way you can replace your job income. It is not something that happens overnight. This is a long-term process. So let's talk about how you can scale your investments up. But before we do that, I want to talk very briefly about how you actually get dividends. In order for you to get these type of dividends, you have to invest in companies on the stock market. And in order for you to do that, you have to use a stock brokerage that lets you invest in companies. And you also want to make sure that the stock brokerage also lets you reinvest your dividends automatically. That way you can accelerate your growth. I'm going to be talking about that in just a second. But one of the most important things when it comes to getting this type of dividend growth is to consistently keep investing into the dividend stocks that you want, and you want to make sure your brokerage can automatically do this for you, which is why I recommend you use something like a sponsor, M1 Finance. M1 Finance is a tool that lets you passively invest in stocks for free, and they also let you passively reinvest your profits from the dividends back into the stocks. That way you can get more dividend profits. The way it works is very simple. All you have to do is create a free account with M1 Finance, and then you can create this pie, which is a portfolio of stocks or funds that you want to invest in. Now, every time that you invest money into M1 Finance, or every time this money is automatically invested into M1 Finance, because you can create a system where every week or every month, money is automatically invested into your stocks. Every time this money is invested, now it's automatically going to be distributed amongst your stocks and funds. Then when a company that you invest in pays a dividend, you can either have this money deposited into your account, that way you can use this money and go and buy a nice dinner, or you can use this money to buy back more stocks. This is called DRIP, DRIP, the Dividend Reinvestment Plan, and M1 Finance doesn't charge you a penny to do that. That way you can accelerate your growth and get more dividends. This is a great tool for those of you that are looking to build a dividend income passively, because now it happens mindlessly. Your money will automatically be invested and your profits will automatically be reinvested. That way you can grow your dividends quickly. Plus, it's free to create an account and they don't charge you a penny to make a trade. So if you want to learn more and start investing passively, that way you can build this dividend income, I got the link to where you can do that with M1 Finance in the description below. Minority Mindset is a paid partner with M1 Finance, so if you use them, we will get compensated, but there's no additional cost to you. It's free to create an account and they don't charge you a penny to invest your money. So if you want to learn more and start investing passively with M1 Finance, I got the link to how you can do that in the description below. So we talked about how dividends grow, and we talked about how you can invest in dividend stocks. Now, let's talk about how dividends can compound. So we're going back to this hypothetical example of a company trading for $100 a share that's paying $3 per share in dividends, which is a 3% return. If you come in and you buy $5,000 worth of the stock, that means you're buying 50 shares. So if you buy 50 shares and each share pays a 3% dividend, that means after 1 year, you are going to make $150 passively in dividends. Now, when you get this $150, I hinted at this a minute ago, there's two things that you can do with this $150. One thing you can do is go out and eat a nice dinner. So I'm gonna draw you a nice plate of food. This does not look like food, but this is a nice plate of food. So you can go out and use this $150 and buy some dinner. I'm clearly no Bob Ross. The alternative, what you can do is you can take this $150 and use it to buy more shares of the stock. Well, I guess this arrow should go over here to the number of shares you have, but you can automatically have this money that you just got to go out and buy you more shares of the stock. Now what's going to happen is you're not going to have 50 shares of the stock, you're going to have 51 and a fraction shares, because if you use something like our sponsor M1 Finance, you can buy fractional shares of a company, which means next year, if assuming the stock price doesn't change, you're not going to make $150, you're going to make more than $153. $3 or $4 might not seem like a huge difference in the scope of 1 year, but you have to remember, we're doing a few different things here. First, we're going to be buying shares of the stock every month or every week, okay? So you're going to be accumulating more shares consistently. Second, we're buying into a company that we believe in for the long term. So we're hoping that the share price is also going to increase, which would also drive this dividend price up. And third, the money you make from dividends every year is also going to be buying you more shares. So that means you're accumulating more shares three ways. You're going to be accumulating more shares just because every month or every week you're putting more money into this investment. That way you can accumulate more dividends. Second, every time you get paid from dividends, you're going to be using this money to buy you more shares. And third, assuming that share prices go up and you get bigger dividends, you're going to make bigger dividends, which allow you to buy back more shares too. So the name of the game now is accumulating equity or shares or ownership in this company because you believe in this company, and the more ownership you have in this company, the bigger the dividends are that you get. So when you combine these three things, first, you're investing into a company that you believe in, which will hopefully cause appreciation in the stock price, which will make your investment more valuable and will hopefully drive your dividends higher. Second, every time you get paid dividends, you're reinvesting this money to accumulate more shares. And third, every week or every month, you're using more money to buy more shares of the stock. So every time you get a paycheck, a little portion of your paycheck is going to go to buy you more shares of the stock. That way you can accumulate more equity, more ownership. That way you can get more dividends. If you do that, you're not going to need $2 million invested to get you this return because of all the things I just talked about. You're not even going to need the $500,000 figure that I talked about. If you do this, you will be able to reduce the amount of cash that you need to do this, to get this income that you need to replace your day job income by another 10% or 20% or 30%. But the key is this is a long-term play. This isn't something that's going to happen in 6 months or a year. This is something that's going to happen over the course of 10, 15, maybe 20 years. And you're going to see that real growth towards the end because then you're going to be able to accumulate more shares much faster. It starts with your mindset. The goal is long-term wealth creation, and in order to do that, you need to accumulate equity or ownership in this company. Thank you for watching. If you enjoyed this video, I linked a video here that I think you're gonna love, and while you're at it, make sure you subscribe to the Minority Mindset YouTube channel below and join our free finance and business newsletter. There are essentially two ways that you can invest in the stock market. You have the cool way, oh yeah, and then you have the boring but profitable way, oh yeah. When most people invest in